Have you ever had that happen?
We create reasonable.
You will now.
My first go around in college, I was asked not to come back. I don't view that pot of money as my own.
Right.
It belongs to the business. TikTok is the worst tax advice there is because
Lord.
every single situation is different.
By and large,
Right.
not great advice.
What would you say from your experience is the single biggest mistake business owners make when it comes to taxes? Scott Sullivan had what most people would call a safe career. He spent years in the corporate world, climbing the ladder, building the kind of resume that usually keeps you there for life. But instead of staying comfortable, he walked away and started his own firm here in Columbus. That leap came with all the fears every founder faces: the responsibility of being on your own, the risk of failure, and the pressure to prove you made the right call. In this conversation, we dive into Scott's journey, and then we turn to the everyday questions business owners are constantly asking, like what entity should I choose? How much should I pay myself? When do I restructure? And how do I plan for the future?
If you could eliminate one IRS rule or tax law forever, which one would it be?
Okay, big guns. I was not ready for that one. I had prepared for other questions I thought you might ask. That was not on the list. So I could eliminate.
We like to catch you off guard.
Yeah, and now you've done so.
Yeah.
Let me have a sip of coffee to buy some time. If I could eliminate one IRS rule forever.
Yep. Or tax law.
Tax law. Oh, God. Man, that is a really interesting question. Okay, so
I think I know I had one in my mind that maybe you were
tell me
going
which
to say.
one you would think.
But
give me
here's
like
the caveat. I think that they already did away with it. But it's the conversation that we had about the beneficial ownership stuff.
Oh, okay. And now technically that wasn't even the IRS. That was TREZ or something. There was FinCEN.
Okay.
Financial crimes. And so IRS law. Well, so the thing is, IRS doesn't necessarily make law, right? Congress sets the law, and then IRS enacts and enforces it and figures out, okay, so you guys said this. How do we actually do that?
Yeah.
I think
Which one is the bane of your existence every day?
I mean, not
all of them.
Yeah, but I mean, it's I think if I could do away with anything, it would be the sort of haphazard rollout that they do anytime something new comes out, and it's where it's just we're doing this, we're getting rid of tax on tips, and then so everyone hears that and they go, great, that's awesome, but what does that actually mean? It's not quite as simple as it sounds, and so then
more of a phase, the way they phase things,
or then
which goes to the Congress, right, and how they have to fit things in their rules.
They just they rolled it out in this bill, and then all of a sudden it's like, okay, what is it? And so it's the lack of, and I don't say it's a lack of communication, because communication exists. It's that people don't either it's not a very exciting topic really to read into the law itself, and B, they've got this sort of, I don't know, shall I call it blinders? Anytime anyone hears tax, and if it's not something they're into, they just like these blinders go up and they hear nothing else. It's like just the end of the conversation is tax. Oh, I don't understand that. The end.
Yeah.
So what I would do, I would probably add some laws or loosen up some
Okay,
things.
interesting.
Yeah, and not make things a little bit easier to grasp and less, I would simplify the tax code. And so there's a lot of fluff and a lot of things that I think are unnecessarily complicated that can hinder business growth or can hinder spending or can, sort of unfairly increase tax for individuals and for businesses. And so I would do away with that. I would streamline a lot of that stuff. I would say if I had to do just one, it would be the deductibility for an individual for the amount of tax, the SALT tax they pay. It used to be you could deduct just about any tax you paid, and it's gotten out of $10,000. Mm-hmm. But even as I say that, it's no longer $10,000. It's now gone back up to 40, but it's going back down again unless.
So you would raise that deductibility, or I
would eliminate the cap on it. And I understand why they did it.
Yeah,
kind of a brilliant move politically. The idea being, if you could make it less attractive to live in the higher tax states, which generally are coastal, which are generally blue, you basically increase their tax. You don't change the tax, but now they can no longer deduct all of their property taxes, i.e. they are paying more tax.
Which isn't that kind of the result of that, and is kind of similar to if you are in an area think rural, or just think something like Tulsa, right? It's middle of the country. Incomes there are going to be lower than LA and New York, right? And so when you have that standard deduction being what it is, and you think of medical expenses, charitable donations, if you don't exceed that standard deduction, you don't get the write-off for that.
Correct.
Right? But if you may be living comfortably in Tulsa, but the people that are in New York making $900 grand a year, they get to take advantage of charitable deductions, and just naturally, because as a percentage of their income, they're going to be able to write it off. Whereas somebody making 150 is not going to be able to write off their church's contribution.
They could. I mean,
right?
it depends on how much they give, right? But the idea was that you could make it just slightly less attractive for people on the coast, and then if you move population inward to lower tax states like Tennessee, Texas, Oklahoma, Georgia, states that are probably going to be red no matter what, you can limit the number of congressional electoral college votes that California, New York, Massachusetts have. Not a lot, but just a few. Yeah. And so, it's never a big swing, right? So if you can carve out 3 just from population base, 3 votes out of California, 2 out of New York, and 1 out of Massachusetts, and then put them in a state like Texas, then now you have won all of Texas. And so now, as opposed to getting the 47 electoral college votes you would have gotten had you won Texas, now you get 53.
Interesting. I've never heard that perspective
as
it pertains to that. It was very interesting.
Kind of brilliant, really. The Koch brothers were the ones that are now they haven't said this is why we've done that, but it's sort of thought to be that is why that
interesting.
cap came
a lot of backroom things
as
going
they deal,
on there.
yeah. And it has in fact worked, because as what we've seen since it's gone into impact is that places like Austin and Nashville and Charlotte and Atlanta have become slightly more popular. You see more people moving to Austin from California than you probably did 15 years ago. Now, it's not the only reason.
Yeah.
But again, you're not talking.
Marginally, it could be.
It doesn't need to be in all. And this little small gains at the margins can make huge differences when we have an electoral college system like we've got.
Very interesting. I will tell you that I would eliminate short-term capital gains.
Okay, how come?
Right off the bat.
I mean, it's in ordinary income.
Yeah. I would just put it to whatever long-term is. If it's just capital gains, it's capital gains.
Yeah, I think we're gonna move your mic closer so we can get you in that mic. We definitely want people to be able to hear you.
Yep.
But so we're gonna do.
Did I lose all that?
We're fine.
Okay.
Yeah, we're fine.
No, we needed
all that
everyone
brilliance,
to see.
man. Just like I lost the ether.
our wonderful producer. We needed everyone to see his hands.
Yeah.
So
normally we talk just strictly about founder stories on this podcast, but we want to definitely get into your founder story of what got you to create your own company, but we also want to talk about tax and finance questions that business owners might have. If they're out there Googling, they're trying to start a business, what should the things be that they think about? But, take us back to your sort of corporate accounting world. How did you end up in the path of accounting? Was that something that you always thought you would end up in, or was that kind of, okay, tell us about that.
No, absolutely not. So I took a rather curvy path, I guess, to get to where I'm at. I was always smart, intelligent, but never really applied myself. I was that guy, kind of a joker. And so when my first go around in college, I was asked not to come back.
Wow.
I think academic expulsion, I think would be a technical term.
What school was this?
This was at Kennesaw State and just north of Atlanta.
Okay, yeah. Okay.
And didn't really take it serious. Just kind of went out and partied. Just never went to class, never showed up to take tests, never did homework. Yeah. And so I was working in cell phone stores. I worked for Verizon.
Nice.
And then back then, 19-year-old, 20-year-old kid, I could make
some commissions.
Yeah. I mean, like not a ton, but I'd make like $5,000, $6,000, $7,000 a month in commission. And when you're 19, that's like, I felt like I was bawling.
Yeah.
And one day did that for several years and was approached. This is, again, you got to go back in time, about 2005-ish area. So came in and sold like 20 cell phones to a guy who was a mortgage broker. And so at that time.
What year was this?
2005.
Okay.
So you see where this is going.
Yep. Got you.
I'm going to lay the groundwork down, right? And so 2005, I mean, he was like just whatever he put on his card. He's like, he's like, he drove like I don't know what it was, like a nice Jaguar. It was like a younger guy. And I was like, man. And so then we became not like friends, but, he would come in and if he had problems with his phone, I would help him out. And he's like, man, this is great. We're doing this, 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 and this. I've got this house I just bought and I'm building this lake house. And I'm like, I ain't building a lake house. he's like, well, why don't you come down and just check out what we do? And so I kind of did that and then got into being a mortgage broker in subprime mortgages, downtown Atlanta, in 2005, which at that time, fantastic. I was like, oh my God, I'd never, some of the loans we were doing were absurd, like 125% over equity loans. Yeah.
What were they called? Ninja loans?
Yeah. There was a bunch. There was CISA, which was stated income, stated asset. There was NINA, no income, no asset. Ninja was no income, no asset job, I think.
No job,
basically, if you had a pulse, you could get a loan back then. And so we could write whatever we wanted to. And the commissions were fantastic. You're talking, 3, 4, 5% on a $400,000 deal. You do the math. And so I was like, oh, this is fantastic. And so for about 2-3 years, I was living high on the hog. I was like, man, why would anyone go to college? What a bunch of suckers. And a client I actually had, somehow, I don't know, I had no business working with me, was a CPA. And at this point, this was towards the end of the run, and you kind of see the writing on the wall. Like, they used to have this website that would basically list all of the mortgage companies that had gone out of business the day before. And it was every day. It was like, this Countrywide, or I'm going to forget all the names, but all these big companies, and they're all just kind of going down. And we're still sitting here trying to do our thing. And, the calls aren't coming in like they used to be, and the commission checks are shrinking. And I'm like, okay, kind of see the writing on the wall here. And I was like, he was a CPA. And I was like, oh, I could probably do that. I'm good with numbers. Let's see. And so I went on and Googled, what does it take to be a CPA? I was like, oh. At this point, I had like 1.5 to 2 years of college, no degree, no real drive to do anything. I was like, oh man, I got to get a 4-year degree, a master's degree, 2 years of work, and I got to pass. There's no way I could ever do that. And so, fast forward, what happened. The entire implosion came through. You try to make it on as long as you can, but it became obvious it was time to, grow up. And so I did. So I relocated down here to Columbus, went to Columbus State, did... I guess I had probably 2.5 years of undergraduate, and I did them in about a year. I took 21 hours a semester, 18 this summer. once I got 4.0
once
GPA.
It clicked too, and
once I was ready. And I'm in my later 20s at this point, so I see all my friends going out and sort of doing normal life things, getting jobs, traveling, starting to have families, and so I'm like, man, I need to catch up. So I did. I flew as fast as I through undergraduate. And I took my very first accounting class. So I wasn't even sure what I was going to do. I just knew I needed to go to college and do something, and took accounting 1. And it's like, I can do this. I get it. People all around me were struggling. And I'm like, no, I see it. It makes sense to me.
The clouds part.
Yeah. it wasn't like this giant sun ray came down, but it was like, this is what I can do. And so I kind of dove into that. And as the classes kept getting harder, I kept just getting it. And I was like, okay, kind of a sign. And so I was like, all right, I'm going to be a CPA. That's my goal. What do I have to do to do that? So I flew through college, went in to Auburn, took I got what's called a MAC, basically like an MBA, but for accounting, master's of accounting. Flew through that as well. Sat for the exam. They were 4 parts. They were incredibly challenging. Worked harder than I've ever worked in my life, while still holding down a full-time job. So I was working at Aflac as a budget accountant at that time, while studying for the exams and finishing my master's degree. And so finished all those, passed the exams, got all the work experience, got my license. Kind of that goal was now accomplished. I was feeling, what I'm going to do with my life. Okay, I can stay at Aflac, and it was great. But I was not cut out to be a corporate guy, and I knew it.
What made you know that?
It turns out when someone asks you what you think, they want you to mirror what they say to them or what they think back to them. They don't actually want to know what you think. And I have a problem doing that. I just would say what I think. And so I didn't really fit in very well. I was okay at it, but I knew it was not my long-term path.
With you getting the MBA or the MAC and then the CPA designation, was there upward mobility for you within the Aflac organization?
Yeah, absolutely.
Okay.
Absolutely. Had I stayed, my last boss, who I reported to directly before I left, because I was no longer in the accounting department, I had moved into a different area at that point in time, is now the president of Aflac Incorporated. And I think people think he may be the next CEO.
Interesting.
Yeah. So had I stayed, and he and I got along. He was a fantastic leader. I learned in the 3 or so years I worked for him, I mean, I probably learned more about not like just business, but just sort of people and how you operate, and just, I mean, like he's where he is for a reason. He's very gifted. But yeah, I mean, I don't know where I'd be. I think about that sometimes. Had I stayed that route, like, what would I be doing now?
And there's definitely questions you have to ask yourself when you're kind of at that intersection of leaving the stability of the corporate setting to go out on your own. So when did you reach that inflection point, I guess, where you were willing to sacrifice the safety, quote unquote, the stability?
Yeah.
You know,
I don't know if it was a moment in time. I always, one of my favorite books was The Great Gatsby. I always loved the kind of allegory story. And one of the allegories in that book is, he's sitting on his palatial estate on one side of the bay and sees the blinking light of a Daisy Buchanan's dock, across the way, and he knows he can never get there. Like, this is sort of this outward thing. At that time, we were on the 9th floor in the tower facing the Aflac Tower on Winton Road, facing the airport, and there was just like this red light that would just blink, and I would sit there poring over a PowerPoint sentence and, spending an hour and a half, well, should we use the word, whatever, should we boil the ocean, or should we, green grass or blue sky? And I'm just like, and I mean, I love people I work with, but, I knew I saw my life, for the next 30 years, however long it was going to be at this company doing that. And I was like, I can't. I saw that light flashing. I was like, man, I got to do something different. And so I, did some soul searching. I thought, I'm going to go and find a startup. I want a larger role at a smaller organization.
Okay.
And so I did, and I found a startup company. It didn't really start. So I left.
And that happens.
Yeah. I mean, it had all great intentions. Everything was nice. But, and so I was the CFO of a startup company that lasted about 14 months, a year and a half. And then I was out of a job. I was like, well, that sucks.
So what were you doing for that company?
I was their CFO.
Okay.
And so it was a company that was set up to do, it was in the energy field or the power field. They were going to start, basically it was a big, large construction company out of the Midwest that fell under Midwest labor union law.
Yeah.
They wanted to subvert some of those regulations and open up a place here in Georgia where our labor laws are a little bit less stringent. And so then they sort of covertly funded this startup to do that. Whatever it was, like, it's not OSHA. It was, God, again, this is from so many years. Whatever the people who look at that kind of figured out what they were doing.
NLRB, National Labor Relations Board,
something like that. It was whoever kind of, it's a union state in Wisconsin. Everywhere in Wisconsin was a union state, and something happened. The company worked for, some of the guys were maybe bad actors and fired some people. And anyway,
that was your first CFO role, though.
Correct.
Okay.
And so that was fun too. That was building something. I mean, that's when I knew, like, I was like, man, I love, like, I can function in a world that doesn't have strict parameters and doesn't have rigid guidelines. Like, I'm good kind of being creative and figuring out problems and doing that sort of stuff.
Underrated talent for a CPA, I think.
I would say it would be why I have been, had the success that I've had, whatever level, is that, I have that ability.
Yeah.
To sort of think about things not necessarily as black and white or as rigidly, and kind of see, curves and lines and find ways to make things work.
For better or worse, you don't generally think about that sort of framing when you're thinking about a CPA.
No.
And sometimes it's helpful to have that framing.
Correct.
But people get kind of concerned, with tax issues, and they don't want to run afoul of those. And then, you talk to some people who, which I'm sure you've had those conversations with business owners, that I've had conversations with people who just readily, talk about the fact that, I'm paying my kids and my wife, and, scratching your head like, okay, well, I mean, I think there's
be smart about it.
There's a happy medium there of what you can and
be
can't
ethical.
do.
Do the right thing. Don't break the law intentionally, and but be smart about it, and don't, there are things that you cannot do, and don't do those things. And so I feel like I can balance those together. But clearly, if you're clearly going to break the law, No.
Yeah, not advised. The other thing I'll say, right, we probably should have said this at the front, but the disclaimer is we're going to have a lot of conversations about tax issues and finance. None of this should be misconstrued as advice.
No,
please reach
not.
out to a professional if you have your own situation. Can't stress that enough.
Correct, and it's a very complex topic.
We'll put it in fine print at the beginning of the episode.
Everyone's situation is that's like TikTok is the worst tax advice there is because every single situation is different, and so.
Well, that's where you get a lot of the talking heads, the 20, 30, 40-second clips of, hey, if you want to start an LLC and pay your kids and your wife and your family members, and there's a certain extent that's true. There's some semblance of truth to a little bit of that.
Those kernels.
But, by and large, not great advice, just as a whole.
In itself, I mean, if it sets you down a path where you find ways to do it. But yeah, I mean, if you just take it as gospel, then correct.
Yeah, TikTok finance is terrible. I get family members that send me things all the time. Have you heard of this? And I'm just like, oh. And then it's like it's a 30-second clip that requires a 30-minute explanation as to why it's wrong.
And oftentimes there's just enough truth in there. Well, I mean, they're not necessarily wrong, but
this person said they made $10,000 trading options last year.
Yeah,
and I'm like, okay, well, do the math. Well, it's because
lying.
They either that or they own $1 million of Microsoft, and so yippee yay, they made 1%. They made 1% selling.
Yeah, exactly.
Yeah, even other advice.
Yeah, exactly.
Even advice around Social Security. Everybody should take a 62 or whatever the bucket. The broad strokes advice is. It's just you want to have your unique situation examined by somebody who knows how to do that.
That's where people like us are sort of valuable, right?
Yeah.
So we
like to think so.
I would like to think so. Yes,
but we have the knowledge. I mean, but it's sort of knowing the knowledge that not everyone's the same, right? And that that every scenario is
unique,
different, and it's going to have its own particular wrinkles, and that's where something like TikTok or whatever isn't going to be able to get into that level of complexity. Right?
So startup is a part of your story. We talked to Lindsay de Oliveira on another episode. She went through Startup Columbus. Ben McMinn and the staff over there, we've been over there to do a couple things for them. That's fantastic. How did you get started with startup? And you were kind of early on in that, right?
That was part of the very first class to go through the program that they call Co-Starters. So the first time that they had run this was been in 2018, 2019. So after the startup didn't start, I went and actually took another big accounting job for about a year, found another role as a again, larger fish, smaller company. And that was the most immediate job I had prior to starting my company. And there was a blurred line. Like I started the company while still working. So I was doing my 8 to 5 and then my 5 to, whatever, kind of building the company.
And you were doing mainly personal returns or business returns or a combination?
I didn't know what I was doing.
Okay.
To be honest. I had an idea of what I wanted to do, but when you started an accounting firm or anything like that, a very common way of doing it is to buy out the book of a retiring accountant. So one day, hopefully, I shall sell my book.
Yeah. Exit.
I didn't do that. I built it from zero, from literally zero, and just sort of through sheer luck, a lot of hard work, a lot of hours, and then good fortune, was able to cobble together, at the early stages, enough business and revenue to sort of keep the lights on in the house and keep, kind of things flowing, not easily. And until it's gotten to where, kind of now it's much more steady state, kind of running organization. But I was going through that, I found it on Facebook. I was just like, at that point in time, the startup organization had just hired Ben. I mean, like literally, I think he had, had been there a day or two or a month before we started doing this. They weren't in the same space they were in. That space was still like a warehouse of some sort. But went through that very first class and just sort of kind of dove into the startup ecosystem here. Have gone back and then, I'll stay involved. And so I have talked to every subsequent class about, has gone through for the past now 6-7 years, about accounting, about finance, about structure. It's one of the things I look forward to doing the most is going back and then seeing those people who were where I was 6-7 years ago with, just, kind of how scary the world is and what am I going to do, and be able to give them some level of assurance and comfort and kind of try and help steer and guide them.
Yeah, these incubators are very powerful tools.
Fantastic tool. It's a great resource in the community. Can't say that enough.
Just when I wish that we would have had something like that when we started. it would have just been incredible to have that. And so we always encourage, especially from so many stories of business owners and entrepreneurs on this podcast, but just encourage anybody, if you have an incubator near you, check it out. It can't hurt.
That's right.
It's free.
What was the biggest thing that you got out of it?
Confidence, I think. So I was at that point in time from the class I went through, and then, not to co-starters is typically at that point in time is like maybe 6 or 7 different people from all over, different industries that didn't, they weren't selective at all. It was just kind of, if you had $250, they're still kind of figuring out everything. I got to play sort of an advisory role because I was just a little bit further along than some of the people I was, kind of my classmates. And I had a little bit more of a fleshed out idea. And, I remember I can't remember when it was exactly, but I'm pretty sure it at that point in time was my full-time job. So for most of the folks in there, they were still in the ideation phase or the, kind of, is this going to be something I can do? Kind of defining their market, defining their product, defining their offering. And I was not. I was going there. And so I got to play almost an advisory role, which I, really enjoyed. And so, kind of put a kernel in my head that like, that's something I can do. And, something I felt like I was fairly decent at. And so that was...
I'm sure they had questions too, like about tax and structure and all that kind of stuff. And they probably were asking you because you were there and you had a background in that.
And they did. And I actually, to be honest, I was still fairly new in my, because in accounting, not everyone knows, if I'd been in corporate accounting for all these years, I didn't know a lot of this. The stuff I know now about structure, about, this is still fairly new to me back then.
Different side of finance.
Correct. And so I had to, learn a lot to be able to give real answers, which is, it's always, it's a good thing to be able to do, right?
Structure is, that's probably, besides the idea of the business, like the structure of how your business is going to operate is probably one of the most, if not the most important starting advice, I would assume, right? It was kind of for us and people,
it can be.
Figuring out. And again, we talked about the TikTok and the online social media advice about how to set up companies, but there's a lot more detail that goes into that. And I'm assuming that in those classes, do you see that people are like immediately acting upon that structural advice, whether it be LLC, S Corp, and those types of things, or do you end up getting phone calls from them later that's like, hey, what did you say again? What was the, what
did you
was
say
that?
LLC?
Yeah, what was it called?
I thought probably more the latter. People generally know those terms or have heard those terms, but they don't understand. I think LLC, they probably do. S Corp is one that people still may not quite get what that point of doing it is and what that actually means, other than they've heard, oh, no, you should be an S Corp. You should be an S Corp.
That's a popular phrase to throw around.
And it
should be an S Corp.
My brother-in-law, my cousin's uncle's friend said I should be an S Corp. Why?
Which is just a tax status.
Yeah, it's right. And maybe you should, maybe you shouldn't. It depends on what you're doing. Depends on and how you structure it. I always say you don't worry. I don't say you don't worry too much about that, but you can always change your structure. It's not, if it no longer works for you. And there's a point in time where it makes sense to be a certain type of entity. And then there's a point in time when that entity may no longer make sense. And again, it just depends on, what you're doing. And maybe if you're going to be, if you're going to own real estate, you should never be an S Corp. If you're going to be in a regulated industry like finance or, you should probably be a C Corp.
If you're going to take on investors.
It'd almost certainly be a C Corp or an LLC, definitely not an S Corp. So, but the thing is with that, it can always change as things go, and you can always, nothing's ever final,
right?
And nothing can't be unwound or undone or redone. And so I would say I wouldn't even worry too much about your structure from day one. Open up an LLC, get yourself an EIN, get a little bit of protection, but that doesn't even do anything for you tax wise. It's solely a liability shield.
Going through that just on our own, when we did ours, we started in 2013. I wasn't even aware at that point that there was someone that would help you with that. Like we were doing it all. We were doing all the research ourselves and figuring out how to open the LLC and what do we need and this and that and the EIN. How do we get one of those? And
this was before ChatGPT.
It was.
This was Google, but again, the information's there. But if you don't know how to read and interpret the information, then it's just kind of like, what's the huh?
Yeah, but that was our default answer. So now, if somebody asks me, like random people will ask me, I'm thinking about starting a business or whatever. What should I do? How do I incorporate? And so my answer is always to them, well, you got to go to the Secretary of State website, and they take a step back and like, I don't want to do that. Can I just hire somebody to do it? Well, yeah, I guess you can, but that's just not my experience with it. We just pulled up our sleeves and did it ourselves. But so as a CPA or as a CFO, outsourced CFO, is that work that you typically do for your clients as far as starting corporate structures for them or recommending which ones they do?
And then, we have attorneys too. We would have come in and do a lot of that, depending on what it is. Basic LLC. Absolutely, we can take care of that for you. Making and all an S corp is an S election. It's a piece of paper you send to the IRS.
And most of the time, it's basically revenue driven, right? At a certain income level.
Income level, and really, all it is a measure with which you're able to avoid a certain amount of employment tax.
Right. What do you think that number is? Does it depend on the industry?
Not on the industry. There's a certain, if you look at it, there's a certain cost to setting up and running an S corp. It's not just a one-time thing. There's going to be recurring costs because you're going to have to run payroll. You're going to have to file a separate type of tax return. There's going to be registration. So there's an amount of money you're going to spend every year to keep this thing going, whatever that costs. And the savings that you're going to generate from taking your income and splitting it into salary, which is fully taxed, employment and all that stuff, and distribution, which misses that employment tax piece, should be greater than the cost of running the S corp itself. So
that's interesting.
As by way of example, if you have revenue or your income is going to generate, let's say $10,000 in employment tax savings from starting an S corp, but for whatever reason, that S corp is going to cost you $15,000 every year to run and to keep going. That doesn't make sense to do. Your cost of doing it outweighs the savings and taxes that you were going to receive. If it goes the other way, where you're going to save $15,000 and it's only going to cost you $10,000, makes more sense then.
It's a cost benefit analysis.
Correct. And now if your income continues, and the way, ideally, the way your income grows, that $15,000 savings in year one becomes $25,000 savings in year two.
Right.
$10,000 is still the cost. And so your cost savings increase though as you go up that ramp.
Yeah, interesting.
If you wanted people always say, when do I know when that number is? When your taxable income from employment, self-employment is around probably $100,000 is when it really makes sense.
Yeah.
I think that's where we landed on years ago in understanding is probably around 100K is
but I've never heard it framed that way. That's interesting that you say that.
No, it is.
Because it's always framed normally with the percent of self-employment. Like, you're going to save 12% or whatever.
And you will.
Yeah.
And that is true. But that amount that you're saving needs to be greater than the amount you're paying to save it.
Right.
Otherwise.
So how does the qualified business income deduction factor into the S corp?
Okay, we're going to QBI 199A.
Yeah.
Well, it depends on
let's just jump right in.
Yeah, let's do it, man. Let's get real. You know what? When I look at a podcast, I want super technical tax talk that really delves.
We will deliver today.
Okay, so are you an SSTB, a specified trade business? And do you make that? It interacts kind of interestingly with 199A or what they call QBI. It is a mitigating factor. Sometimes it can limit some of the savings if you lose your QBI deduction or lose part of it because of it. So it's when we're looking at the S election and go no go. I've got this through the years. I've built this sort of fairly robust analysis tool in Excel because I've got very good at Excel working in corporate America for as long as I did. And that's been improved now with ChatGPT. So much more, it looks nicer now. And so we say, what are your parameters? We plug them all in. And so it kind of at the very bottom spits out like, okay, you do this, you're going to save this much. It's going to cost you this much. Is A greater than B? Cool. That's the way to go. It's B greater than A. But then, even then, do you expect to take on investors in the near future? And if the answer is yes, then do not do S corp.
Yeah.
As you do, you're going to have to undo it most likely when the investors come in, because investors are not going to want to invest in an S corp because you can't have non-natural people or non-natural whatever the word is, not human beings. It has to be an actual individual. Can't be an LLC or an entity investing in the S corp. Investors don't like that. They want to be in right. So. It's a much broader topic than just money savings.
Well, I think that it goes back to what you were saying in the beginning, which is your qualms with it was like, they have this structure out there, but they don't necessarily tell you how to implement it properly.
No.
And you just have to try to figure
Are you
that
talking
out.
TikTok? Yeah, no.
Well, no, I mean just the federal government. When they put out, the IRS put out guidelines, whether it's tax on tips or the QBI stuff, it's just murky. Like you don't understand because you have to be in a certain industry. Are you in a service industry? Are you different industry?
Right.
There's this whole flow chart that you go through that can change the outcome based on like parameters.
And I would say, I mean, they tell you how to do it, but they tell you how to do it in their language.
Right.
And if you don't speak, they don't speak their language, then correct. They don't tell you how to do it.
Or even the S Corp, what you have to do with the S Corp, which is a reasonable salary.
Correct.
This is a reasonable salary to whom? So it's how do you do that in what
and there
industry?
is no definite,
that's right.
I mean, there's no, benchmark saying this is what it must be.
Right.
I mean, we have sort of internal benchmarks that we look at, and we want it to be sort of approximate of a certain percent of the income of the business. So if you're doing $2 million a year, and you're the CEO of the company, and you want to say 20,000 is the reasonable salary,
Yeah. Well, it's also industry specific too. If you've got a really
And
like
geographic.
capital,
Is it true that
business?
Because I've heard this, and I'm not saying that we do this. I don't really know what we do.
Don't admit to anything on camera.
Yeah, but I mean, I don't know, but I've heard it said that you can't go wrong. That it's assumed you can't go wrong with a 50-50, right?
You
a
could.
50 split. So
I mean,
if you're at 400 grand, 200K could be salary, 200K could be distribution.
And maybe. Depends on what you do. I mean, if you are, let's say, a computer programmer in the AI field, and you have 15 years of experience and you live in Silicon Valley,
maybe a different split.
And it's going to be subjective because it is intentionally not meant. There's not a rule that says it must be a percent or a number. It's reasonable, which can be many things. And so you make a defensible case, and they, if they'd want to, can make a defensible case against you. And it's your job to prove to them, not their job to prove to you.
Have you ever had that happen?
We create reasonable.
You will now.
That was a knock on wood in case anybody
I've
missed
never
that.
specifically had that question. No.
Okay.
In under examination or under audit, although as part of the S Corp setup that we would provide for a business owner or starting from, we create a reasonable salary report. We keep that on file, and then we update that every year with what the business is doing revenue wise, what the market is doing, and incorporate some Bureau of Labor statistics, and we
It's a sliding scale that can go up
and we
or
want to
down.
make sure that salary stays in that kind of reasonable range that this kind of analytical report comes out with.
Okay.
Have we done that? Do we have the sliding scale, the Bureau of Labor Statistics?
I don't know. That's a good question. We've got to
Yes,
ask our
we
CPA.
do. If the IRS is watching,
Well,
yes, we do.
If you'd like to,
Yes, we do.
You're more than welcome
So
to set up. We come out and we can look and make sure that whatever you've got is reasonable. And again, I mean, your odds of being examined are, I don't want to say slim to none. They're low.
Yeah.
They are. And as long as it's, again, I mean, it's reasonable. I mean, there's the cases that we hear about going through business school, going through, the CPA who paid himself a $10 salary and had $1 million
Yeah.
firm. Just kind of egregious things where it's like, that's not
kind of
possible.
asking for it at
Yeah,
that
I mean,
point.
like-
So if assuming that, a business owner, doesn't do anything like that, where, it's honestly, we're being reasonable, we're trying to do the split to get the S Corp to be, and you've done the cost benefit analysis. What would you really say? Because those are kind of technical situations that most business owners, when they're starting, aren't really encountering.
Correct.
What would you say from your experience is the single biggest mistake business owners make when it comes to taxes?
The single biggest mistake would be to have a nonchalant attitude about it and just sort of, they're never going to find me. I'll never get looked at. They're going after the big fish. They'll never come after me. I can, I'll have my boat on there. I'll have my beach house. I'll make that a tax, and they just try and get, they feel like they can just get away with doing whatever they want. And they can until they can't.
Yeah. It's
And then
time
when
limited.
It's very
And when
interesting,
they
yeah.
can, I mean, it is, it can be, I mean, I've seen it put businesses out of business because they just simply, they have tax bills they can't do. I mean, they've been shut down literally because they were just treating their business like it was their own personal bank account.
We talked a lot about that. Yeah.
No effort to distinguish between personal and business spending. Just, everything gets written off, and it's, again, get away with it. You can, you will, up until you don't.
Yeah, so that kind of goes back to the split of income versus distribution and the concept of being reasonable. So it's really just apply a little effort to be reasonable about what is and is not a business write-off.
Treat it like a business,
and don't
Separate
take
your
liberty
business.
where it's not there.
Correct.
Separate your business and personal finances.
Oh,
Oh,
that's a big
100%.
deal. Yeah.
And then
big deal.
I don't think about like the business cash, like my business bank account. I don't think about it as being Scott's or mine. It's the business's account.
Right.
And technically I own the business. So I mean, I get it, but like I don't view that pot of money as my own.
Right.
It belongs to the business. Now I take some and I take a salary and I take distributions as needed. I have a lifestyle, but that is not my money. That's the business's money. And so I'd never, ever. I mean, I'm super kind of anal about it because I don't get the, oh, whoopsie, I didn't know.
Yeah.
I'm held to a little bit higher standard. Yeah. But, never use the business card for any personal expenses, never doing, I mean, just, like occasionally my wife will, and I would, I mean, like, I told you not to do that. Like,
Yeah.
Just treat it like it's two separate things, two separate ships. You got the personal one, that's where you do all the, stuff you want to do, and the business one, that's where that's happening, but never to,
Yeah, we've always been very, very good about that, with the exception. We'll get some clicks on this, maybe, right?
Good, clicks are good.
So when we're if we're doing an event, or if we have clients in the office or something we're doing, sometimes we'll DoorDash, right? Okay, and the business card is on there now.
If only we knew a CPA to ask.
The business card is an Amex, and my personal card is an Amex.
Yep.
So I have been known to mistakenly get DoorDash to the house at the business expense.
So Matt, what you're doing is admitting what you're doing here is admitting tax
I did not
fraud.
say we wrote it off. We can go into QuickBooks and cancel it out. But every now and again, Garrett will send me a screenshot and said, "What are we having for dinner tonight?"
Yeah. and okay, so
this is the world of Apple Pay, where
because the card gets saved in there, and it's like, okay, it's the Amex.
So technical Scott says you should never do. But okay, it happens all the time. Whatever. Yes. Don't deduct.
But you can go in your QuickBooks and you correct that.
Now what? If you want to get, again, super duper technical about it, that should be considered wages to you, and you should pay payroll and income tax on that.
Ooh, burn.
Yeah.
And we will do that. Yeah. We will absolutely 100%
Is the IRS going to find a 36 or whatever, I don't know how deep your DoorDash budget rolls, maybe $40, $50?
Don't answer that. You don't want to know.
More 100. I mean, I don't know what you're... again, so chances are very slim that if they do examine, even, they're going to find that one transaction, they're going to pay, okay. Yeah. But it's when it becomes habitual and it becomes consistent.
Well, every day at the office, your grocery bill, your personal grocery bill becomes your business. Yeah, it's just taking liberty that's not there. And just to be reasonable is the best course of action.
I mean, I see all the time people just using their business. That's their primary card, their business card. And then, they're going to the grocery store, swiping. They go on a cruise. They take, they're paying cruise. Stuff like that. And it's just like, dude, don't do that. Like, what do you... And so we'll end up stopping working with those people. If you aren't... Because what I have is an obligation not only to, the ethics, the IRS, but I have an obligation to my other clients as well.
Yeah.
And so what ends up happening, right, is when people typically get caught for doing stuff like that, it's not necessarily you getting caught because you're just one out of 300 million, whatever.
Yeah,
it's people like they look at my number, and so my little PTIN number goes on every single tax return I file, right? And so everyone that goes out has my number on it, and the IRS looks at patterns in my filings to identify.
So if they catch one or two, they're going to come after the other 100, technically, because of possibility.
So they're going to audit your entire client base.
I mean, probably not. But if they see, and that's, you hear about every year. There's always a few of these people getting caught here in town, all over the country.
Yeah,
making up fake Schedule C's and fake dependents and all that stuff. That's how they find them. They see that PTIN number, 1, 2, 3, 4, 5 on average has. People who have $10,000 of income and $40,000 in losses from a Schedule C. And we see that across, not just one return, but over 300 returns. They're going to start looking at those individual returns.
Did not know that.
Are ultimately responsible for what's on there. Even if I prepare it and my name and signature on there, as a taxpayer, it is your responsibility to make sure that's correct information. Yeah. And so it falls back on you as a taxpayer as well.
And I think people that, if they're engaged with a CPA or a tax preparer that's being a little more
Lenient?
Yeah,
You can say
lenient.
shady. And I mean, I can, if you want, I can on camera. I can name like 5 or 6. I know that operate in Columbus.
Let's not do that.
No,
Let's do it. 3, 2.
I got their names.
I double dog dare you, which means you have to do it because I double dog dare you. No,
Okay.
no. I think from the individual, they're thinking, well, they said I could do it, but it is ultimately your responsibility because you're the one they're going to come after as far as paying the taxes back.
Correct. And the penalties. And
yeah, and I think some of that can come too for the average person or the average like just startup entrepreneur that sees things like when they're not talking with a CPA or an outsourced CFO and they're seeing the TikTok or the Instagram advice and they can, hey, I can justify my family vacation as a business trip.
We're going to call it a board meeting, and we're going to don't do
and
that.
I've seen we're going to have a board meeting every year at Hawaii, and I've seen these people and they're on YouTube saying they do this, and I'm like, you are going to get audited. You got 1 million views on this. How many IRS agents have looked at it?
You're basically admitting a tax fraud publicly and telling, right. But even then, probably not. It's the mighty Wizard of Oz, right? As long as you believe that they exist.
Yeah.
But I mean, the current administration, and has been for years, have been cutting costs, cutting workforce, limiting. So the IRS, doesn't get as many hits as they did maybe 20 years ago.
Until Palantir gets their software in the system.
You don't want to be one that they do.
Yeah,
because the number they get is not 0.
Because I think this is kind of a rabbit trail just for a second, but I think that the moment that the IRS gets AI or the software to be able to go through these tax returns, 1 million a day during tax season, the audits may pick up pretty quickly. What do you think about that?
I mean, if they know what they're what they're looking for, and I mean, what they're looking for are very common, not many common things, but they're what they have, at least from what we've been told, is these cobbled together systems that have been in place for years that don't really communicate with one another. And there's not really a way to get a holistic picture from their perspective without like actually going and like finding you and finding all your stuff. I mean, one individual could do that, but there's no computerized system that can. That's all right. When AI and large language models and these sort of high powered computers get together who may be able to put together, especially the more complex stuff, you're going to see an increase in enforcement, and
the national debt will be wiped away within 1 year.
Well, what's the biggest myth you see about write-offs and depreciation and things like that from business owners? Deductions.
I mean, the biggest myths, it's all kind of the marquee stuff. I can hold a board meeting with my family in Aspen and write that whole thing off because I have an LLC that somehow has a board of directors. Which
I've seen this on.
I have to, and it's we keep notes and we I think it's sort of knowing enough to not know what you're doing, but getting yourself in trouble by doing it. And so there's no shortage of sort of bad advice. Over 6,000 pounds, you can write an end of vehicle off, and it's business expense. And all.
Yeah.
And kind of. That's not true, but
we've looked a lot into that, and it's much more complicated than it sounds.
Right, and it's got to be useful for the business. So, like, I'm a CPA. I can't write my truck off. I don't really need, I don't need a truck to do my job. Or if I do, it's a very small percent.
Unless you're carting your files from your house to your office every day.
But even, right.
You can't write off commuting, though, right? You can't write off trip to your office.
No.
Yeah.
But and so it's just sort of thinking that because this law exists, that it exists for you. And it doesn't, no matter what. And so, if you are a plumber and you are making house calls and you're driving around all day in a truck, yes, 100%. As a business use of a truck, that is a correct usage of it. If you are a hairstylist and you're trying to write your vehicle off, but you don't travel and you're just going from your house to your shop and back each day, that ain't a write-off. That's not a business.
What if you wrap it? Because we hear a lot of that too about
advertising.
The wrapping, is that legitimate?
That's a good question.
I would probably say you could probably advertise the actual wrap itself. Maybe the cost to do that could be considered advertising, but are you going to write the vehicle itself off? No, I wouldn't think so. I mean, people do. If it gets examined, probably wouldn't hold up.
It goes back to reasonable, really. Yeah.
And so,
which is something, it's very interesting. It's eye-opening. You go back to the IRS is generally viewed with a lot of hatred, and I understand why.
And rightfully, not rightfully so, but there are good people in the organization. They're not.
The rules aren't it's not as draconian as you think. It's about just being kind of the expectation of operating in good faith is really what the IRS has, which is interesting because, again, they're like a parasite that just sucks on us. But, it's just a recurring theme. So all of our love and shout outs to our IRS agents.
Yeah.
And they've got a tough job. I mean, they're understaffed, they're overworked. It is not a glamorous job by any means, and everyone they talk to dislikes them. I mean, imagine if your job, you went in every single day and every interaction you had with everybody, they disliked you. It'd be awful.
Yep.
Yeah. So
just act in good faith and be reasonable.
Just do the right thing. You know what the right thing is. And if you make a tiny little boo-boo, like you court DoorDash or something.
Like DoorDash.
Yeah, I mean, okay.
So we'll kind of move on from that, but what role do you as an outsourced CFO play that a bookkeeper or a tax preparer can't do?
So the biggest difference, and there's a lot of bookkeepers who parade themselves as CFOs or outsourced CFOs, become kind of a popular thing here, is long-term strategic view. And what that means to everyone is a little bit different, but it's not necessarily just how do we, classify your transactions and prepare forms and make sure that we meet minimum compliance. It's how do we optimally structure your business to accomplish your 3, 5, and 10-year goals, and what steps can we take in order to enable you to be able to reach those goals? And so that can mean a million different things, but it's having the sort of larger level picture, the higher level view of your organization, what you want to do, and how you want to grow it, not necessarily just taking care of it as it exists today.
Right. Forward-looking projections, things
Correct.
like that.
I mean, budgeting, forecasting to a degree, but then also, if you believe you're going to be taking on investors and you want to do so in the next, say, 2 to 5 years, you're currently structured in such a way where you're not going to be, attractive to investment from outside sources. What can we do today to sort of get the ball rolling so that when you do go to market, you are now more attractive? Bookkeeper's not going to be able to do that for you. And how do we make it that way? And what do we do? And then, when do we pull that trigger? When do we put things in? The other part is controls, a lot of internal controls. And I hate it, but I mean, many businesses that I've worked with or am aware of have had theft, employee theft or some of the kind where they just had a fairly lax control environment for whatever reason. And people, kind of find these weaknesses, take advantage of them, and steal money from the business. And it usually starts with a conversation where the owner will call me in. They say, I feel like my P&Ls look great. I'm making money every month. I'm not seeing the cash. Like, somehow or another, the cash just never, my bank account never really starts, if I'm making all these profits, why isn't my bank account going up? Now, it's not always fraud. I mean, not it, but, it's sort of going through and looking at, how do you control your spend? And who has access to this and who can do that kind of stuff?
What is an example of the worst case of internal theft or fraud?
I love this one. I got some good ones. And okay. I hate that. I mean, I hate the thief.
Yeah.
It's like one of those things where I hate people who take things that aren't theirs. So it's just not, the most agree. It was one of the first ones I ever came into when I first got going. It was a family owned company, of course, they almost always are. Mom and dad built it, started it, built it, got it, good. They wanted to kind of pull the reins back, and they wanted, their son to come in and sort of take over for them. And they had the best intentions. So that's sort of what was going on. When I got in there, it was that situation. Our P&Ls look great. Everything was good, but we're having to constantly put our own money back into the business, and we just don't quite know why. Can you help us out? I said, okay. We start looking at all the books. We start kind of going through and not really doing a forensic audit, but just sort of coming in and sort of, getting to know the business and multiple ways that the son was end up stealing from him. One of the ways, and I thought this was actually kind of ingenious, was because he had signatory authority, and they had several business accounts. He had signatory authority on one of the main ones.
Single signer?
Signatory authority, so he can sign, like he was an authorized signer of it.
Right.
He was able to set up a bank account at that same bank, a personal account that used the business account as the overdraft protection account.
Oh, okay.
Right? So he would keep no money in this personal account, swipe the debit card or do whatever with it. It would bounce, but as opposed to bouncing, it would just pull the money from the business account. And so we're blind to that. We can see the transfer going out, but I mean, they had 10 different bank accounts, and so they had transfers going all over the place. And so it doesn't necessarily stand out right away that what this is.
Yeah.
And that's when I first heard about OnlyFans. And this is way back. It's like 2018, 2019. It's kind of common now, but I was like, somehow or another we'd investigated. I think we had to subpoena his bank records. And I was like, what is ONLFNA? I was like, what is this? And I Googled it. I'm like, okay, awesome.
My gosh.
It was like $90,000, I think he had done.
So you're doing like legitimate forensic audits on this?
I mean, it wasn't a forensic audit in like the technical sense, but yeah, I mean, we were kind of digging in to find out what was happening. And then once
$90,000 on OnlyFans.
Over the course of like 6-7 months.
Wow.
Damn.
Yeah, I mean, there's other things too, right? I mean, again, I didn't even know what it was. I mean, like, this is 7-8 years ago.
Well, I mean, people get creative when they get desperate. There's it's the mother of all invention. So you get
the parents kept bailing them out and bailing them out, and and even on this one they said, well, how can we help them out and how can we bail them out? And, it's like I just found and it was more than that. It's like I found y'all $150,000 that was stolen. And you just want to make it sweep it under the rug and it's going to go away. It's going to happen again. Yeah, and they go, we know.
That's the challenge of like generational businesses, where you're taking a business from the one generation and handing it down to the next, or even the third. That's why a lot of
the third is always the one.
Yeah, a lot of businesses don't even make it to the third generation. It's just a different mindset. I mean, what's your approach in early years with founders to helping them navigate cash flow issues? What's your recommendation to them?
Always keep a certain amount of cash on hand at all times, like a floor. I say 6 months of, what's it cost to keep this thing going? Like 6 months of just operating cash. Make that your goal to have no less than that at any time. Know where it's going. It's not difficult, especially if you're going real fast and you've got a lot of people who have access to be able to use cards and charges and all that. For there just to be, redundant subscriptions to a million things.
Yeah.
You have 15 different Amazon Prime accounts that you're paying $20 a month for. And it's not that one individual, but it's all of that in accumulation, will just bleed your cash right out. And then just make time on a regular basis to sit down and make it a priority to review it.
Yeah.
It's entirely too common, or common enough, where people, as they're growing real fast and they got a million things going on, they neglect that part, and then they're just bleeding cash and don't even know it. And then 6 months down the road, 8 months down the road, they've bled $100,000 and don't even know why.
Yeah.
And so just take, 20 minutes a month, whatever it is, just to look at it and make sure everything kind of seems more or less right.
Yeah, I mean, that's where tools come into play.
But you got to use tools.
Yeah, QuickBooks is one tool. Do you think QuickBooks, if QuickBooks went away tomorrow, do you think the business community would cheer or would they cry?
It would, they'd find an alternative, right? It would be challenging for a little while until something came up and took its place, like Xero, but
well, it's been the de facto standard for a long time.
It has.
And I think I've had this conversation with a lot of people. I think they're kind of pricing themselves out of certainly the startup space. It's just really expensive, especially if you're adding payroll and other things to it. It can get up there.
Well, certainly can. If you saw the invoice I pay to QuickBooks every month, it's startling.
Yeah, ours is probably 10x what we paid when we started.
Oh, and
but we're invested in the ecosystem.
Yeah, so I wholesale it, and so I pay for, I don't even know how much. It's a big number.
Yeah, but you're locked into the ecosystem. So we started in 2013, so we've got all the history and all the data in that system, right. And it's hard to go to like a FreshBooks or a Xero or something like that and start new from that. Yeah. But if I were a founder today, I'm not sure that I would look at QuickBooks as a first option, unless I had a CPA who was like, "Hey, you probably should look at QuickBooks." Are you able to work in those other systems like Xero or FreshBooks?
Yeah, I can work wherever. Although, I will say I work the most in QuickBooks. Yeah, but it's right size also for kind of smaller businesses. There's a point when QuickBooks no longer makes sense. A client we had was running an $80 million a year company on QuickBooks Online.
Yeah,
it's like when I first came, I was like, no, we need to beef this up a little bit. But the price difference between like that QuickBooks and then like the next step up is pretty stark. Yeah. QuickBooks is maybe a couple $1,000s at most. You get into like Intact or NetSuite, you're talking $40,000, $50,000. So it's a big jump.
Yeah.
And then above that, you get into like SAP and Oracle, which is a few million. And so, there's some pretty wild swings there. And so QuickBooks does a good job sort of hitting that smaller middle market. By far, is it perfect? Absolutely not. Good enough. And it works more or less okay, other than, a million things it doesn't do right. But
my qualm is not necessarily with the technology part of it. It's just with the constant price increases. That's
every 6 months to a year.
Yeah, it's crazy. Getting fatigue over that. How do you help founders balance the growth opportunities with the discipline? You talked a little bit about that.
With the discipline of
financial discipline. So keeping the financial discipline, but also knowing, like you said, projecting into the future about growth opportunities. How do you balance those two things?
Yeah, that's tough. And my role, is as an advisor, and I can't tell you not to do something. I can tell you that maybe you shouldn't do something, but if you're hell bent on doing it, I can just say, here are the possible consequences to doing it.
Yeah.
And anytime I'm asked a situation like that, that's how I'll approach it. I'll say, pros, cons list kind of thing. Like, okay, you're going to do this. And these are your potential pros. Here is what could happen. Are you okay accepting the risk of A, B, C, D, E, F, G?
Yeah.
And if they say, I am fine taking on that risk, then, my obligation, my job is done. Sometimes and I want to make sure they really understand what those risks are. Because it's one thing just to say, well, they might do this, but like, what is that? If they do this, what does that mean? And what are some other potential second, third, tertiary risks that exist that could come as a result of this decision? Trying to give them as much information as I'm able to for them to make an informed choice.
Yeah, that's good advice.
Yeah.
When we talked a little bit about M&A, because that's kind of the wheelhouse that you're in, but when a company is thinking about having an exit or a sale, what's one of the first things you tell them to think about, or maybe to clean up or something like that?
Get your house in order. Get your everything in your, when due diligence on an M&A deal is going to be the most annoying, you are going to hate the firm doing the M&A due diligence.
Yeah.
Whatever it is, it's a quality of earnings audit, if it's a financial, they will ask you the same question 10 times. Now they're doing it on purpose to see if your answer changes.
Yeah.
But you'll be like, I told you a week ago, but they're doing it. So be prepared to be frustrated and stressed out for as long as this process is going to take, 6 months, a year, whatever it is. Do everything you can now to get every single thing in the house in order. Any skeletons you've got in your closet, put them out there. If you've got this, just don't hide anything. Don't, just full transparency, put it all on the table. They'll either take it or they won't, but don't try and hide anything, and make sure your records are, they're going to find stuff.
Yeah.
But make sure that you can try and limit the amount of stuff they're going to find.
Realistically, how easy or difficult is it to hand a business down from one generation to the next? And then what are your tips for starting that conversation with heirs who might be coming into the business in a second or third generation?
Sure. How easy is it to do? It can be real easy.
With a company that has private shares, I guess.
Yeah. And if you're, the hardest part is making sure that you're okay with turning the reins over to somebody else and not being the one that calls the shots anymore. And I think that's where the original generation may struggle the most with. Because if you do that, then it's no longer yours. And if an heir wants to change something that you disagree with, well, they can.
Yeah.
And you can't stop them, and you don't have the control. So understand, not having the control and what that's going to be like. Have them work in the business so they're, they kind of know it, and don't have them start at the very top. Have them start, if it's
sweeping floors.
Yeah. It's something, get them involved. And everyone knows it's the owner's kid, but make sure that they go through and that they understand the business and they're in it for, years. Don't have them come in day one as the boss. Have them, kind of work it up. And then sell it to them at some, don't give, but sell.
Right.
And, make them have some skin in the game, and make them, don't make it easy for them just to come in and do it. And then, be okay with them doing, because, once it's theirs, they want to sell it, you cannot stop them. And so you're going to have to reconcile the fact that you no longer have the control over something that you have built, and it's no longer yours. And that's a struggle, man. People have a hard time with that. They do.
Yeah. Well, I can see it. Founders, you build something and then you kind of hand it off and you want somebody to take care of it. Right. But you can also foster that culture so that the next generation will view the ownership in a similar way. They've grown up in the company that's theirs, their family name may be on it. I don't know. So there's a lot of different ways you can do that.
You've seen even in the corporate world, people handle that transition. Look at the Walmart family, the Waltons, and look at the, is it Truett's, Chick-fil-A? The Truetts.
Yeah, I don't know if the
Kathy.
Truetts are still. Yeah, the Truett Kathy. Yeah, I don't know if the Kathys are still involved in Chick-fil-A.
Yeah, I think one of the sons is grandsons maybe is the CEO.
Yeah, so I think the takeaway there is to be intentional every step of the way.
Absolutely.
So that you can figure out, okay, if my dream of this carrying on the next generation, okay, is it doable? And if so, start planning now, incremental steps, and prepare that person. Because it's different to build something versus to run it.
Want to do it also. Oftentimes they may not want to. The kids may have different interests, or the kids
which
may not
which is okay, which is fine, right? Yeah.
And then but don't if you kind of guilt or force them into doing it, they're going to they don't really want to. So make sure that's something that they're interested in doing, and you'll find the way to do it.
Yeah, well, this has been a great conversation.
Yeah,
we could go on for a couple of more hours.
Yeah,
but he'll start billing us after the first hour.
No, I started billing day one. Come on, my stopwatch.
Well, you get the award for our longest podcast, but we appreciate your time.
Okay, you want to keep going? I can keep going.
Yeah. Well, we appreciate your time. We'll let you go, but we'll have you back out here. No, we'll have you back. We can do this again. The conversation can continue.
I love talking, and we want to get into sort of specific topics, or there's one I like called the Money Guys podcast. I think I might have mentioned it to you guys before. Yep. It's a CPA who's a financial advisor and another guy who's just financial advisor, and they break down TikTok videos. And they're like, terrible idea. What are you doing? Like,
I've seen those, I think.
Yeah, I love that topic. I love talking about it, and I love talking about bad ideas and bad TikTok videos. But it's informative. And, I watch that show, and I actually get advice from them in certain things, or, starting to get some advice, and then you go and investigate and you kind of figure it out. But
yeah, cool. Scott, we appreciate it. Bridge Path CFO Solutions.
Yep.
Check him out. He'll help keep the IRS at bay.
Not a guarantee.
Not a guarantee.
Yeah.
Not a guarantee.
We'll do round 2 soon, but thanks for coming out. We appreciate it.
You guys enjoy it. Thanks so much.
Thanks for hanging out again with us for another episode of Fountain City Founders, where we sit down with business owners and entrepreneurs of all sizes that have made a positive impact in their community.
Yeah, and so away from the podcast, Matt and I run Momentum Wealth. It's a boutique firm where people come to us for one of 3 reasons, really. They want help with investments, they want to feel confident in retirement, or they just have a big financial decision that they don't necessarily want to make alone.
Yep. And if you're nodding your head to any of that, you're not alone. We help business owners, families, and individuals alike be the most successful they can be in their finances.
Yeah, so visit us at momentumwealth.us. Reach out. We'd love to start a conversation with you. And hey, thanks for watching.